So to discuss valuations, market positioning, and also how should one approach mid and small cap stocks as a portfolio and a cluster, I have with me who is a mid cap expert and a specialist. Samit Vartak joins us to take the conversation forward. Samit, fantastic to have you back and thank you for joining us.
My pleasure.
We are calling it the big reset. Is it a big reset?
So definitely, I mean, it's I think one of the biggest fundamental change for India. Now the question is whether it's a big reset for all the companies or it's a big reset for selective companies. I think that's where from an investment perspective, that's very important to understand. So I would say if it's a competitive industry where there are too many players, at a similar level playing field, it's going to be very difficult for those to retain the profits. So if their ROE goes up by 15%, because of the earnings going up by 15%, I think over a period, and in a very short period of time, they will price each other out and then the ROE will come down to the same levels as what they were before. But there are many industries, where the competition has been decimated. And you will find it across various sectors, whether it's capital goods, whether it's specialty chemicals, whether it's alloys. There are multiple sectors which you need to filter through. That's where I think the pricing power will be retained, because to build up the capacity in that space, it will take at least 3, 4, 5 years. And such companies have built up the capacity over the last 4, 5 years, and the valuations are at multi-year low, or probably at the historical lows, and that's where the opportunity is. I mean there are dominant players that which everyone is aware of, whether it's the top banks or the top NBFCs, they will definitely benefit. But question is, how much of that is already priced in? This is a rare opportunity where I think there is a real fundamental change, but still people are very skeptic about the changes, and especially the ones where the stocks are beaten down. But I think that's where the big opportunity will be, and that's what you need to spend time. I mean, you'll need to dig through and understand the competitive environment in that specific industry, and bet on the players where they are so dominant that it's almost impossible for the new competition to come in. Whether it's the offshore competitor or whether it's the domestic competition, it will be very difficult to build the kind of competitive advantages that they have. And these are very basic industries which are not going to be disrupted by any high tech, because if you talk to the PE guys or the venture capital guys, they are so excited about a lot of disruptions that are going to come through in India, that for them many of the consumer oriented, where distribution channels are very important. You don't know whether the 5 years down the line, and when distribution channels get disrupted, big modes of consumer oriented companies can be disrupted. So you need to be very careful on those aspects, because if you are paying 70, 80, 90 times for earnings growth of 10 to 15%, and if there is a big disruption which comes through, it may not happen in the next 2 years, but it can happen in the next 5, 10 years. And the derating which can start, can be a big hit on your portfolio.
Okay, just to break it for our viewers, what Samit is saying is that yes, there is a big fundamental change in the economy, but not every company or every sector will benefit in the same manner. Companies which have a moat around them or have an IP around them, they will have the ability to retain the tax cut, but there are some companies who are more like a, one more in the crowd, they will have to pass on the tax benefits. The way markets have gone up, it's like a rising tide, and markets are thinking that every company would benefit.
Right. Yeah, I mean, that's the general risk. When things change at an industry level or a complete macro level, it's very difficult to retain the profits. Again, I have always been talking about the theme of market share gain, and market share gain happens only if there is one dominant player and there are weaker players. The difference between the competitiveness of these players is huge. So you look at all the dominant players, whether it's a Bajaj Finance, whether it's an HDFC Bank or a Page Industries, you look across sectors, those are the players who have grown at a significantly higher rate compared to rest of the competition. And with this change, I think that kind of theme is going to accelerate. And this theme anyway works across the up and the down cycles. And this is a complete flip that the government has given such companies, because the profitable ones will get even more dominant. So you got to find companies where valuation is in your favor.
Are you fully invested in this market?
Yes, I mean the money that we raised in the last, we were not raising money until late 2018. We have stopped taking funds.
Your view was that mid-cap were reaching a bubble level. After that, reality has dawned.
Right.
And you raised capital after that. So that was a great call. Now, what is your call?
No, I think in this kind of market, you need to be completely invested.
So don't suffer with this recency bias, which is that just because mid-caps have suffered in the past, they will continue to suffer. And just because large caps have made money, they will continue to make money.
Right. See, the opportunities, mid-caps and small caps, maybe the market looks at it from that perspective. For me, the dominant player, can be the largest player in that industry. But if the industry is small, he may not be part of the large caps. So, but he would have as big competitive advantages as many of the large cap players. And I think that's where the opportunity is, because even the best of such players have taken a hit just because it's part of the mid cap. Suddenly in the last 2 years, markets are differentiating between mid caps and large caps, which generally doesn't happen. You got to differentiate between by looking at the competitive advantages.
Differentiate between the business rather than the market capitalization.
Exactly, and that's what the market has done, and that's where the opportunity is.
So give me an example of a category which may not be the market size of the category may not be $5 billion. But you have identified themes or companies which are dominant. The size of the market may not be large, but the themes which you identified are actually they're in themselves dominant and very good quality companies with high return ratios.
Right. So, one of the examples is steel pipes. The steel pipes which are used in building factories, building airports, all kind of infra projects, or even affordable housing where you use it for door frames. Steel pipes. It's a very basic industry, but you look at the number of players over the last 5-6 years. The number of players have just shrunk. There are only 2 or 3 dominant players. Even the weaker players have sold off their manufacturing.
PSL used to be one, MAN used to be one. Some of those companies do not even exist now.
Right, and I'm talking about the cross-section ones, where they manufacture these square or the rectangular pipes, which are not used for the liquid flow. But you look at the industry, it's been decimated, and there are only a couple of players who have built up the capacity. The return on capital is upwards of 25%. If this theme of attracting new capex, and especially if foreign money also comes in, India will go through a huge construction boom in the, at least in terms of factories. Who is going to benefit the most? The guys who have the capacity and can provide. So it's a small industry. It probably would be, $10 billion industry. So the player in that, is not going to be that dominant. It's not going to be that big. But the biggest beneficiary of the capex build-up will be the top guy in this. And people are just not giving any valuation to such companies. I would say that their growth rate going forward, as well as their dominance going forward, will be bigger than some of the consumer-oriented companies. Because if you look at the consumer-oriented companies, many of the consumer, they don't even manufacture those products. They just brand it. And when you look at, guys like Amazon with all of their private level products available on the website, which are available at 20-30% discount, and all of these companies now trading at 50, 60, 70 times multiple, I'm not sure if their dominance is going to last for that too long. And it's an extremely competitive industry. Anyone can come in, get the product manufactured by outsourcing it, and put its own stamp and sell it in the market. There's no real differentiation between the products. Whereas the competitive advantage is that some of these basic steel manufacturing companies, where you look at their various levels of dominance, whether it's sourcing the raw material, whether it's their working capital lines, line of credits, what kind of rates they get, their manufacturing ability, as well as their distribution ability. It's very difficult to build all of those 4 aspects of the business, and that dominance, I think, is going to last much more than even many of the high load consumer oriented companies.
Okay, so there is one sector where the disruption is real, disruption is here to stay, and disruption will change the way how future business would be conducted, future transactions would be conducted, and that's autos. Now, whether EV will see a light of day today, tomorrow, after 10 years, I don't know. But it's going to cap the P upside for a Maruti or a Bajaj Auto and auto ancillary companies. Do you own auto or auto ancillary?
I'm very, very careful about the auto or auto ancillary, especially the ones which are geared towards the passenger vehicles.
A man from Pune talking negative about autos.
Because I think there are huge headwinds. It's not just in India. You look at globally, all the passenger vehicle auto players are going through a huge structural change, even in China, Europe, US, India. So you can't bet on themes where anyway there is a big disruption which may not happen in the next 2 years, 3 years, 5 years, but definitely in the next 10 years. And at the same time, the consumer behavior is also changing, with the Ola, Ubers of the world, which everyone is talking about. So why get into such things? Because for me, growth is the most important aspect. If I don't see growth of 20%, I just avoid that kind of a sector. And I think auto is one of those.
If I look at great compounders, Asian Paints, even HDFC Bank, Bajaj Finance, they've always been expensive.
Yes.
And a quest for a fund manager like you is to avoid the haloed stocks, avoid the overcrowded stocks. But if I look at the performance, these stocks have given you good returns, and I'm not talking about 1 year, 2 year, I'm not talking about these small periodic bouts on a 10-year period, on a 15-year period. They have been great compounders.
Yes.
They have been less volatile. They outperform in a fall, and they always give you satisfactory returns. Is there a learning for all of us when we look at some of these classic businesses, but we avoid buying them because they look expensive or they are overowned?
No, you are right. I think especially during the last 2 years, you have seen the benefit of owning those quality stocks. But I think you got to 2 years is not a longer period. You got to look at over a cycle. Most of these companies, barring maybe like a Bajaj Finance, typically grow at much lesser than 20%, and especially the consumer-oriented companies. So if your returns expectations are in the range of 10 to 15%, there is no reason for you to go hunting for anything else. Just hold on to these companies, and the valuations do not matter if you are going to hold on to them for at least 15-20 years. So it's a no-brainer for a passive investor. For a fund manager, yes, if your returns expectations, once they cross 20%, I don't think you can hope for re-rating perpetually in these stocks. I mean, they already are trading at such valuations that going forward, you can only make the earnings growth as your returns. And the earnings growth, if it's going to be 10-12%, then if you're happy with those returns, yes, that's great for you. So that's my problem. But yes, I mean, there are certain companies like Bajaj Finance, which I'm happy to hold because they're growing at that kind of, and I'm fine overpaying for higher growth. But if it falls below, like you have seen the example of Page Industry, I've held it, I held it for multiple years. But by 2016, the growth rate fell below 20%. As soon as the growth rate stops, and comes back to the normalized growth rate, these companies lose their P multiple, and you would never know which company will go through that kind of a cycle. There will be only 2 or 3 such companies which will sustain it for next 20 years or 25 years. But I don't know whether you have the ability, because you would have said the same thing about iShare or a Page, and you may have the same kind of losses which a lot of mid caps have gone through, if you bought them at the highs. So question is, in which part of the market is the risk reward in your favor? I would say it is definitely not in your favor if you're buying at such valuations, and if your time horizon is like 5 years or 7 years. You can imagine that at a 10-11% growth, it takes 7 years to double the earnings, and an 80 times P multiple goes down to 40 times P multiple in those, and it can happen, right? Because historically they have never traded such valuations. You make zero returns. So whether you want to take that kind of a risk, especially given that India can go through, with this incentive that the government has given, a higher growth rate phase. So once the higher growth rate phase starts, and there are more alternatives available for investors to get into such companies, people will start to get out of those, because in the last 7 years, the rest of the universe had stopped growing, and these were the only companies who consistently grew. And that's where a lot of foreign investors as well as Indian investors flocked into these companies. And if it reverses, I'm not sure if these companies will maintain such high P multiples.
There is a big if, which is that
Yes.
when will corporate India start spending? When will the earnings cycles pick up? What will happen to corporate capex? It was supposed to pick up not in 2019 but in 2016. Whatever may be the underlying factor, the bottom line is that we are staring at an ugly reality where government had to give a tax cut to really kickstart the investment cycle. What if it does not pick up? I'm looking
Yes.
at the dire scenario.
Right. No, it is possible because it's not that companies will flock into the country just because of one incentive. Coming into the country has to become easy, and then starting a business has to become easy. For that, the government has to go for the land reform and then the labor reform. Given the intention, I think, given the conviction of this government, I think they will get it done. If that is done, you can look at the interest rates are at the the lowest levels. Commodity prices, whether you look at steel, they are at extremely low levels. You have the tax rates which are at the lowest levels, and the government is inviting you. I feel it's not, this move would not have been as valuable if it was done in any normal circumstances, because today it's the right time, right place. China is giving you an opportunity where many companies are, the new capex that those companies will put will be in some other geographies. So you get this window when you got to grab it. If you don't grab it now, those companies are not going to shift their plants once they are already set up in Indonesia or Thailand or Vietnam. So the timing is extremely important. I think that's the reason the probability of this working.
Can India survive in manufacturing? Made in India ended up becoming only a slogan by the India One government. The attempt was to reboot the renaissance of manufacturing in India. Frankly, last 6 years, with the exception of 2 or 3 large big ticket investments, nothing has come.
I mean, look at the chemical belt. I think India is pretty, after China, probably India is the dominant chemical. So a belt was formed, right incentives were given, and the ecosystem was there. I think that is what needs to be created. It doesn't need to happen across the nation. You find certain pockets where the land prices are really low, where the ecosystem is there, where you have the right skill sets. If it's planned well, I don't think we lack anything, which any other countries have. And if the government plans it right, has the right intention, it can be done. It's definitely not impossible.
So would you say, let me use the cricket terminology. Every pitch, you need to have a different strategy. Sometimes go on the front foot, sometimes go on the back foot. Couple of months ago, or right now in 2019, those who've played a defensive strategy in the stock market, they've benefited. You bought consumer names, you bought NBFCs, stick to the mega caps, and you managed to outperform the market. But do you think now it's time that we take a leap of faith and go on the front foot and start buying risk in the portfolio?
So I'm not in the favor of buying risk. Obviously, I mean, you can take a tactical call of that, but it's betting too much on the luck. I feel you find these players who are dominant in the industry available at cheaper prices compared to the historical valuations, and they will definitely be more dominant 3, 4, 5 years down the line. It's definitely to go after such B2B players who are, I think, more geared towards capital goods. So you look at these steel pipes manufacturers.
Anything else which is there on your radar?
Electrical cable manufacturer, because they, whether this theme plays out or not, anyways they are dominant and highly profitable. They will benefit from it, and they are exposed to the real estate sector. They are exposed to the general, the factories, all kinds of construction, as well as the consumer-oriented retail business. So you look at that, there are certain niche businesses, like alloys, which are used in steel manufacturing. There are such industries where there are just 1 or 2 players, extremely dominant, almost impossible to get into those businesses because most of them have burned their fingers and got out of such businesses. And if India grows at even a higher rate, their growth rate can be significantly higher. And especially if this theme works out, and the commodity growth is higher, like the steel industry, these companies are trading at 2, 3, 4 times multiple with return on capital of upwards of 30%, sitting on huge cash, no issue of debt or balance sheet, promoter holding 75%. And such companies, I think, can go through a huge re-rating as well as huge growth over the next 5 years. And that's where the opportunity is.
How have you managed to convince your clients in this market fall to keep calm? All mid-cap stocks have got beaten. Whether it's right or wrong, we are not getting there, but the price damage and the collateral damage has been there. What are you telling your clients? How should they keep the calm, perhaps not redeem or invest more with you when the entire sector per se has got derated?
No, it's extremely difficult because whatever you tell them, if they see damage in their portfolio, people get concerned. It's human nature, because a fund manager may see visibility in certain companies, but as a passive investor, you may not have the same conviction or the visibility in those names.
Samit Vartak there sharing his insights on the big reset that has been witnessed by the markets.